Hi, I'm Junaid Bray. I'm one of the portfolio managers on the Nedgroup Investment SA Equity Fund, and I'll be taking you through the performance of the past quarter and the past year. So if we look at what markets did in the last 12 months in Rand terms, you had the Caps Wix doing about 7.9%. And if we look at the breakdown of where that performance came from, domestic equities actually did fairly well, 14% in Rand. Financials and industrials also did well, around 20% plus minus. And I think the real negative performance came from resources, and I'll touch a bit more on that later in the presentation. If we look at global markets, emerging markets in Rands did about 18%, and you can see on the far right, the world markets in Rands especially had done about 33%, so very strong market backdrop in the last year. If we look at our fund performance, we had a tough year last year. We did about 1.4% against the benchmark of 7.9 and the peer group of 5.8. That peer group that we're showing on the charts are SA equity funds with domestic equities only, excluding funds with an offshore allocation. Our longer term track record is still pretty much intact. We've done about 12.7 compound over 3 years and 9% compound over 5 years. And over the since inception period of the fund, we did 7.6 versus the benchmark of 7.9. So comfortably still outperforming net of fees since inception. And we're pretty much coming up to close to our 10-year anniversary. In the next 2 or 3 months, we'll reach our 10-year anniversary. So that since inception number goes back nearly a decade now. A number that we like to look at, which highlights the consistency of outperformance of our fund, is really the bottom table. So if you look at rolling 5-year periods, which I think is a much more fairer way to assess the outperformance or the capability to add alpha for the fund, rather than just looking at a 1-year period, you can see that nearly 80% of the time we outperform the peer group average, and over 80% of the time we outperform the benchmark over rolling 5-year periods. And you've got nearly 10 years under the belt now for that statistic. This slide really just shows you the outperformance of our fund since inception, and you can see the top green line is our fund and how that outperformance has widened over time against the middle line, which is the market, and the bottom line is the peer group. So we still stand out as outperforming quite nicely since inception. If I just focus on the last quarter and looking at what worked out for us, and I'll touch a bit more on this if I look at the 12-month numbers, we had a significant position in Foschini, which performed quite nicely into the fourth quarter. Anheuser-Busch, we added quite a lot of Anheuser-Busch earlier on in the year, and in the last quarter, the company came through with quite decent results and announced a share buyback, which was quite well received by the market and ran quite nicely. We were adding to Mondi as well. We felt that the market hadn't really priced in the benefit of the Russian operations being sold. And we were quite positive that they would realize a value that could be extracted, and that took place in the last quarter, as well as them announcing that they'll pay all of those proceeds out as a special dividend, which was quite well received by the market. We also had a substantial position in insurers, and I'll touch a bit more on that, so momentum coming through. If I look at what detracted from performance, were a couple of shares that we didn't own, which performed very strongly, Harmony Gold, Capitec, and Goldfields to an extent, all detracting from performance. And then what detracted as well on top of that was Sasol and Pick n Pay. If I look at the snapshot over the last 12 months, really in terms of what detracted was, I think Pick n Pay was quite a disappointing performer for us. I think the change in strategy, with the change in CEO, was quite unsettling. And I think that was quite a significant change in the thesis as the strategy has now changed, and then the impact of load shedding, as well as the increasing the competitive dynamics with the much stronger Shoprite really putting down the hammer and seeing that a lot of those costs not coming back. I think that reset the earnings base, and the company underperformed during that period. Sasol, we were quite constructive on the oil price last year. In terms of years of underinvestment, and as demand was expected to recover, which did really play out until the third quarter, but then some company-specific issues at Sasol in terms of the chemical cycle being a lot worse than expected, and the down cycle being more protracted than we initially expected, as well as increased capex coming through and impairments, really it caused Sasol to underperform during the period. And then gold shares, particularly Goldfields and Harmony, which Goldfields was up about 64% last year. Harmony doubled, which we didn't have in the portfolio. On a relative basis, those detracted. In terms of what did work out for us, I think, not owning Sibanye, which had underperformed with the platinum cycle coming off, and we had substantial positions in insurers, mainly Sanlam and Momentum. During COVID, these insurers had obviously taken a massive amount of COVID mortality claims, and we were of the view that should normalize, which really played out. I think last year you started to see more normal earnings coming through with the help of market recovery, and these shares had outperformed quite strongly, and we benefited from that. And we have been reducing our positions into as the shares have outperformed, and I've touched on Mondi and Foschini earlier. If I look at how the portfolio is positioned, so really, if you look at the way we bucket the portfolio, I think, a reasonable exposure to the global consumer, and we continue to hold Naspers and Prosus. So the Chinese market has been under immense pressure. I think the macro environment and outlook has certainly changed a lot. I think a big part of how we had positioned about a year ago, we had expected the Chinese reopening trade post the COVID lockdowns, the stringent COVID lockdowns, to be quite strong. I think that fizzled quite quickly with much more structural macro challenges within China and a much lower growth outlook going forward. So with that, and on top of regulatory uncertainty, has seen the Chinese market sell off quite aggressively, and Tencent has sold off with that, de-rating substantially, and we think it's incredibly undervalued at the moment. In fact, our two portfolio managers were in China last month and have come back. The macro environment is certainly soft, but from a company perspective, Tencent is in a very strong position. So in terms of margin recovery at the business and the profit trajectory, that looks very solid. And you're buying that now at, we think, Tencent probably ex-associates trades at a 10 times earnings. And then you're buying that at a discount when you're buying Naspers and Prosus, and the management are doing more to unlock that value. We continue to hold British American Tobacco in the portfolio. We think that we expect in the next 12 months they should announce a share buyback, and then the dividend yield of 10% is a nice underpin there. We bought quite a lot into Anheuser-Busch into weakness earlier on in the year. And our thesis there is really just as margins recover, because there's a delay on the high costs that they incurred when commodity prices had spiked in 2022. As prices rolled off, they should benefit from that. And as they pay down their debt, we think that there's actually a strong earnings recovery up ahead. So we continue to hold that. On the SA Financial side, we're still seeing a lot of value, especially from banks, the likes of Absa, trading at incredibly low valuations, 6 times PE, high single-digit dividend yields. And we think that they're well positioned into a rate cutting cycle, as well as lower credit losses, which we expected to come through. We continue to hold insurers as well in that space. And then if you look at SA Inc., selective positions, despite the tough macro, we think that companies like TFG, you can still gain market share. They're coming off quite a low base in terms of discounting and margins. Those should recover, and we're still seeing upside on valuations. And then so resource exposure, we've still got quite a bit of resource exposure, the likes of the diversifieds, and then Sasol and Mondi. This really just gives you a snapshot of how the portfolio is positioned. So it's important to highlight here, it's an SA equity fund, but just the structure of our market, when we look at it from a bottom-up perspective, only about a third of the portfolio is actually SA Rand earnings and valuations. The rest is from outside SA, the other 2/3. You can see that, the emerging markets ex-South Africa, which a big part of that is really Chinese exposure via Tencent and commodity exposure. That makes up another 17%. And then you can see other developed markets, actually a big part of it, mostly the miners, the global consumer companies. And if you look at on the left, you can see about 30% of the portfolio exposed to the global consumer. And then if you look at our SA exposure, banks, we've got a substantial position in banks, about just over 20% of the portfolio in banks, where we see a lot of value, and then diversified across the other sectors in the market. If you look at some of the trades we did last year, really taking profits on the positions that worked out very well for us, Aspen performed very well last year. We sold our position there. Momentum performed strongly. We sold out there. Reduced Goldfields and Standard Bank. And then some of the on the left side, some of the bars where we saw very attractive valuations and increased our positions. We've spoken about some of them earlier. This gives you a snapshot of the top 10 holdings in the fund. We've spoken about most of them. If I look at the market outlook from here, what does the macro backdrop look like? So we know that I think it's a consensus view that we at the peak of the current rate cycle, and inflation is rolling off. This is globally and in South Africa, and we're expecting rate cuts to start coming through in the next couple of months. Possibly, we think locally, possibly into the second half of this year. We've got lots of geopolitical risks at the moment, which are rising. I think we've got something like 56 elections around the world at the moment. That's this year, including the US and ourselves. And then obviously you've got rising tensions, between the US and China, Russia and Ukraine. That war is ongoing, and the Middle East tensions still flaring there, which is a bit of a volatile background for this year. And then if you look at some of the SA risks over and above the normal risk, we've obviously got the elections coming up. That might create some volatility and uncertainty. And I think the big concern at the moment, actually, from an economic headwind, is the logistics and water constraints. I think that is not something that it's easy to fix. I think there are steps in the right direction with Transnet and bringing in private sector players into the Durban ports, the Joburg-Durban corridor, into the Cape Town ports, but those won't be solved in the short term. So I think that's something that's a bit worrying. But on the flip side, I think if you look at a tailwind that we do have, we think 2023 was the worst year of load shedding, and we do think our base case is that things improve from here. So if you just think about where we are right now, last year this time we were probably averaging stages 4 to 6 of load shedding. We're probably averaging stages 2 at the moment, 2 to 3. Most of the corporates we speak to can handle up to stage 4. So we think you should average this year at least 1 to 2 stages lower on average than where we were last year. So I think some of those costs coming out, and lots of corporates had actually invested in backup power, etc. So you should see cost savings starting to come through. So we think that some of these catalysts, at the margin, any positive catalyst, and if we remove the election uncertainty, could be a key catalyst to drive earnings and a re-rating of our market. The next slide really just shows you, if you look at the far right, the amount of private sector projects that were registered with NERSA. You can see since they removed the caps, how that spiked, and these includes households as well as corporates investing in renewable energies. From a valuation perspective, we're still seeing lots of value in the SA market. If you look at the top lines, those are the global markets, starting with the US, which is I wouldn't say it's overly expensive, but it's probably trading at at the upper end of reasonable valuations. And as we look at our SA markets, we're still trading at very depressed levels relative to global as well as emerging markets. And when we look at the domestic market, we have a custom index that we make that looks at just the domestic companies, excluding the miners and the global consumer companies, trading at depressed valuations. So we're seeing a lot of opportunity here, and on risk-adjusted basis, these are the kinds of stocks we're adding to our portfolio where we think there's a lot of upside from current levels, and we're confident that the portfolio is well positioned to generate good returns over the next few years. Thank you.